Hi guys, welcome back to my YouTube channel. So if you haven't subscribed, please make sure that you do so as soon as possible. So a lot of you have been asking me to do accounting videos, so I just thought the least I can do is to do a video on ratios. So that's what we're on about today. So we have four types, or rather four classes that we'll talk about when we're talking about ratios, right? So the first one is the short-term liquidity. So when we are talking about liquidity, we are talking about your ability to easily convert whatever that you're dealing with into cash. So if we're looking at how easy it is for you to turn your assets into cash, right? Or to turn your inventory into cash, or to turn your accounts receivables into cash, or to turn your accounts payable into cash. So that's what liquidity is about. And if we are saying we are talking about ratios that focus on short term, that means we are talking about things that are current, right? So remember I said there are four classes, so this is the first class that I'm going to deal with. So under this class we have one, two, three, four, five ratios, right? So I am going to focus mostly on the inventory turnover, this one, and this one, right? Because these first two are very easy. So for the current one, you are looking at the possibility of your current liabilities to pay your current assets. So you'll just say current assets over current liabilities. And then, so obviously we want it to be big, but not too big. We might want it to be 1:1, right? Or or anything that is less than 1 could be 0.9:1. As long as you are able to pay off your current liabilities using your current assets, then you are still fine. And then we go on to the asset test ratio, right? So for the asset test ratio, you are looking at whether you will still be able to pay off your current liabilities if you didn't sell more inventory. So if you stopped right now and you didn't sell any more inventory, would you still be able to use the current assets that you have, right, to pay off your current liabilities? So meaning you'll take your current assets less your inventory over your current liabilities, right? So those are the first two, and they're very easy. And then we get to the serious stuff. The first one is the inventory turnover rates. Think about it. What does turnover mean? If someone says turnover, what do they mean? They mean go back, right? So here we are talking about how many times does inventory actually, how many times do we go back to suppliers in order to replace our inventory, right? So it shows us how many times inventory has to be replaced. Turnover means going back to suppliers. So think about it. Turnover, going back. Where are we going back? It's about inventory. So we are going back to suppliers. Why are we going back there? Because we have to replace our inventory, meaning it has run out, right? So we obviously want this to be as high as possible, right? But not too high, because you might not be able to, it might indicate that you are not able to meet your sales, right? Which might lead to customers leaving you and going to your competitors. So from the definition, I can conclude that, remember, I'm talking about like how many times, like how many times, or how long does it take me for me to go back to my suppliers, right? But I go back to my suppliers because I sold, right? So it's gonna be cost of sales over your average inventory, right? And then we have the second one, which looks at your stock holding period. So they'll talk about turnover, and then they'll talk about holding. So the holding is going to be the inverse in every case. In inventory, in accounts receivable, and in accounts payable, it's going to be the inverse of this. So it's going to be average inventory over cost of sales. And remember, holding, what does holding mean? Holding on to something, right? Not letting it go. So stock holding period tells you how long you hold on to stock, meaning that how long it takes you until you sell, right? So think about it. It tells you it kind of tells you how many times you're going to sell per year. So if you're only selling once, right, that's not a good sign. So we obviously want it to be as low as possible, right? Yeah, we want you to hold on to the stock as low as possible. All right, let's move on. And then we have the accounts receivable turnover. Remember, turnover means going back, right? So with accounts receivable turnover, we are looking at how many times accounts receivable is generated. So how many times am I going to get accounts receivable, right? And then our debtors pay, and then I go on and I get it again. So I'm going back inside in a circle, right? I'm getting it, they pay. How long does it take until I get it again? So it tells me how many times accounts receivable is generated in the entity. And remember, accounts receivables has to do with what? With our sales, right? Because we are selling on credits. So what are we going to take? Sales over average accounts receivable. With the average, it means you're taking your opening plus your closing and you're dividing by 2. So yeah, a high ratio will show you that we have efficiency in collection of accounts receivable. So meaning we want this ratio to be as high as possible. We remember, accounts receivable is generating new assets, right? Your assets are increasing. This is an asset. So obviously we want it to be as high as possible, which will show that I'm efficient in collecting my money from my debtors, right? I hope you guys are understanding. And then the fourth one looks at collection, right? So collection, as the name suggests, tells us, we'll say, how long does it take until we actually collect the debt, right? This one was telling me how many times it's generated. This one is telling me how many times does it actually take me to go and get back my debt, right? So it's going to be 365 over whatever this was. So it's going to be 365 over the accounts receivable turnover rate. And obviously we are going to have to compare this to our credit policy, right? So your credit policy is that policy that tells you, do you expect your debtors to pay within 30 days? Do you want your debtors to pay within 90 days? So you'd have to compare the two and see if this one aligns with the one that you have, right? And then the fifth one is the one that talks about accounts payable turnover, right? Same as the accounts receivable turnover. It's going to tell you how many times accounts payable is generated. And it's to get the formula, to get to it, you need to take your net purchases on credit, so whatever you bought on credit, over the average accounts payable, right? And then we look at the collection period for accounts payable. And what did I say? It's going to be 365 over whatever this was, same as the accounts receivable one. Hope you guys are understanding. So those are the ratios that we have. So let's just take a recap. We looked at, we looked at short-term liquidity ratios, right? And we talked about current ratio, asset test ratio. We talked about inventory turnover, meaning how many times do I go back and replace my stock. Holding, how much do I hold onto the stock. And then we talked about accounts receivable turnover, meaning how many times is accounts receivable generated. And then I talked about the collection period. How many times does it actually take me to collect my money from my debtors? And then we talked about accounts payable turnover. How many times is accounts payable generated? And then we talked about accounts payable collection. How many times does it take for my creditors to actually pay? For my creditors to actually come and get their money, right? And then the next type that we are going to look at is what is my capital structure and my long-term solvency. Solvency, you know, when people are insolvent, it means that they are not able to pay off their long-term liabilities using their assets, right? So we have 3 very easy ratios. The first one is my debt ratio. So the debt ratio tells you, remember, we have sources of funding that are different. You could take a loan, you could use shares, right? So remember, total assets is equal to what? Owner's equity plus liabilities. So the total assets are funded by either my owner's equity or by liabilities. So we want to know as to like this in terms of your sources, in terms of what you use to buy your assets. Is it more, do you use more of debt or do you use more of equity? So how much of your total assets are actually bought by total liability? So it's going to be total liability over total assets. So the higher this ratio is, the riskier it is to invest in this entity, because it's telling you that it's telling you that a lot of your assets that you're buying are coming from liabilities, right, instead of shareholders' equity, right? And a lower one tells you that it's secure to invest, right? And then another interesting one is the interest cover ratio. So the interest cover ratio tells you how much of your profits before your interest expense and before your tax, right? How much of that profit covers your interest expense, right? So the reason why we look before tax is because you're going to pay the tax either way. So it would not be wise to say after tax, right? It's going to be before the tax, because this tax payment is independent of whatever interest expense you have. So interest cover, right? How much of the interest is covered by my profit, right? So the higher the better, because you want to be able to pay off your interest expense. And then we look at the last one, which is gearing. So gearing is a debt to equity ratio now. It looks at to what extent does your debt as compared to equity cover your source of funding. Here on the debt one, we're looking at how much of my total assets are borrowed using total liabilities. Here we are actually looking at whether do you use more of debt or do you use more of equity. So the higher, same as here, the higher this ratio is, the riskier it is to invest in this entity, and then the lower it is, the more secure it is. So remember, this capital structure and long-term solvency, you are going to use this if there's a question that is asking you whether someone should invest in this business or not. I'm going to use this in the one that we are going to do, the last one that we are going to do, right? And then the formula for the debt to equity ratio, you can either use the interest-bearing liabilities over equity. If you are not told which liabilities bear interest, then you're going to use your long-term liabilities over your shareholders' equity, right? Because we are trying to see how much, to what extent does my source of funding come from liabilities as compared to equity, right? And then this, obviously, as I said, is going to be of interest to someone who wants to invest, to someone who wants to, for example, borrow the entity money, borrow the entity a loan, right? And then we look at the second last one, which is about efficiency and profitability. So this is about internal measures. We as the entity, we want to know how we are doing, right? It's not about the external people. So obviously it's going to be things like my gross profits, it's going to be my profit margins, as well as my asset turnover ratio, right? So let's go over it. So my return on assets looks at how much our resources were able to generate profit for us. So the return on assets, right? What does return mean? Return or earnings is basically about my profit. So what we are trying to figure out on the return on asset ratio is how much, right, how much did my assets generate profits, right? So to what extent were my assets able to generate profit for me? So the equation for that is going to be profit before interest expense, but after tax, right, over asset. And we obviously want this to be as high as possible, because this is telling you that your assets are actually generating you profits. So we want it to be as high as possible so that we can get more profits, right? And then let's look at the gross profit margins. So remember, margins are talking about gross profits, right? And gross profit looks at how much of sales are left after you have paid off your cost of sales, right? How much of sales are left after you've paid off cost of sales. So you're going to take your gross profit, but remember, gross profit is sales minus cost of sales over sales. So I want to know how much of sales is left after I have paid off the cost of sales, right? Times 100. And we obviously want this to be as high as possible, because sales generate me money. They are not a cost. They are not an expense. They are an income into the entity, right? And then we have the operating profit, right? So the operating profit looks at how much profit is left after you pay off your operating expenses. So remember, on your statement of profit and loss, you have that line item that says operating profit. So you're going to have gross profits, you're going to have other income, other expenses, and then after that you're going to have operating profit, right? So that's the operating profit they are talking about. You are looking at how much profit is left after you have actually paid off your operating expenses. So it's going to be your operating profit over your sales, right? And obviously you want this to be as high as possible, because it's profits and we love profits. And then the next one looks at the net profit percentage. What does net mean? Net means you are taking whatever amount you have, subtracting adding all your income and subtracting all the deductions you have to make, right? So meaning that the net profit percentage looks at how much sales are left after you have accounted for income and expenses, including your interest, right? So it's gonna be the profit for the year. You're gonna that profit at the end before you get to comprehensive income. Here's that profit. So it's gonna be profit for the year, right? Because you're trying to find how much profit is left after you've taken into account your income as well as your expenses. So it's going to be profit for the year over my sales, and I want this to be as high as possible. We also talked about the asset turnover. It's the same as the one I mentioned first, and this is like looking at how much our assets are generating sales, right? So it's going to be our sales over your average total assets, and we obviously want this to be as high as possible because it's showing that my assets are efficiently generating profit for me, right? And then the last ratios are about performance, and these ratios are of interest to our shareholders, right? Because they are the ones buying shares into the entity and they want to know whether they are going to get good return, right? So the first one is return on equity, right? And then I'm going to discuss these ones. So return on equity looks at how much our ordinary shareholders get from profits. So return, right? How much you are getting from the profit that we are earning as an entity. So remember, you invested into the business because you wanted to earn something, right? You wanted to get some sort of return, right? So this ratio looks at how much that return is going to be based on our profits, right? And it's obviously going to be profit after we pay tax, because there's no point in thinking that you're going to get money that you will not get, money that will be paid to SARS, right? And the reason why I emphasize on ordinary shareholders is because remember, the preference dividend is fixed. It's not based on your profits. So when we are talking about return on equity, we are basing it on profit. So we have to subtract our preference dividends. So it's going to be profit after my tax, because we're talking about return on equity. So it's going to be profit after my tax minus my preference dividend over my average ordinary shareholders, because I'm specifically talking about ordinary shareholders, not including all the shareholders that I have, right? Hope you guys are understanding. So that's the first one. The second one is earnings per share. Earnings is talking about profits as well. It's talking about return. It's the same as the return one, right? So earnings per share looks at how much each share earns the shareholder on profits, right? So unlike here, where we're talking about a value, here we're talking about a value that you'll find in the financial statement. Here we're talking about the average ordinary share holder value, right? Here we are talking about the number, right? Because we are saying per share. This is basically return on equity per share, because what you are taking is this whole thing. You're going to take the same numerator, so it's going to be profit after tax minus my preference dividends over now the number of ordinary shares issued, right? So the higher it is, the more our shareholders are going to be attracted into coming into the entity, right? Because it's telling them that they are going to be earning a lot of money per share, right? And then under the earning per share, you have two types of ratios. You have the earning yield. So once they say yield, think of markets, right? So meaning whatever that is happening into the entity, I am comparing that to what is happening in the markets. So earnings yield, think about it without even reading this. Earnings yield, we are talking about how much you're going to earn, how much the shareholders are going to earn as compared to what the market would actually give them, right? So it looks at or compares what the company gives its shareholders as compared to the market, right? So it's going to be your EPS, earnings per share, over the current market price per share. Remember what I said, if you see the word yield, think of the markets. So we're looking at what the entity is going to give its shareholders per share as compared to what the market would actually give the shareholders if they had invested somewhere else, right? And then we are almost done, guys. And then it's price earnings ratio, right? So it looks at whether our shares are overvalued or undervalued, right? So it looks at the prices of our shares and it tells us whether our prices are overvalued or undervalued. And we are going to compare this to the market one, right? So if our shares are overvalued, it means that our shareholders are putting value into our shares. That's why they are buying more. And as a result, it's shooting up our prices, right? So if shareholders are overvaluing our our shares, right, by buying at higher prices, then it indicates that the shareholders are actually optimistic about the entity. They think that the entity is going to do well even in the future, right? But if they are undervalued, meaning that the shareholders are not that willing to buy at higher prices, then it's telling us that the shareholders are pessimistic, right, about buying. They are not that confident the entity will do well even in the future, right? So price earnings ratio is going to be the current market, it's going to be the inverse of the other one. It's going to be your current market price per share over your earnings per share, right? And then we have dividend per share. So remember, earnings was talking about profits. Earnings per share was talking about how much does each share get, how much of the profit does each share get. However, dividend per share is now telling you how much does each share get of the dividends that you are declaring. It's not talking about profit. Profit, earnings, right? Profits go with earnings, but dividends are talking about the dividends that you're going to declare. So remember, you're going to have the profits, and you might not declare the whole profits as dividends, right? You might declare some of the profit and retain some of the profits. So here we are talking about the dividend that you declared. So it's dividend per share, and it looks at how much each ordinary shareholder gets as dividends, specifically ordinary shareholders, because preference shares are fixed, right? So ordinary is going to be the ordinary dividend amount, right? The one you see on your statement, over the number of ordinary shares. Remember, with the earnings per share, it was the profits minus preference dividends over the number of shares, because it was per share, right? So a higher value tells us that we are paying more and retaining less. So the more we are paying, the less we are retaining, right? Because the profit can either be declared or it can be retained. So if you are declaring more of the profit, means that you are retaining less as the entity, right? So you have less retained earnings. And then the last one is the dividend yield. What did I say about yield? Think of market, right? So the dividend yield looks at the dividend in cash that investors can expect to receive in the future. So it's basically looking at what is the amount of dividend that each share would earn if it was in the market, or if they decide to sell the market and go to another entity, right? So it's just going to be dividend per share. So it's going to be this amount over the current market price at the end of the year. So yes, guys, I hope that helps. Good luck for your exams. And another thing, I'll be hosting an economics bootcamp, and there's just so much on my shoulders, hence I'm not able to do videos. I'll try to do videos there and there when I get extra time. So please sign up for the bootcamp if really you need help with economics, because I might not get time to do economics videos. So if you are interested in the bootcamp, you can send me a message on WhatsApp. Enjoy the rest of your day, and good luck for your test on, let me not say the dates. Good luck for your test.